the mathematical optimization, which is in the core of our service, it's actually not that much used in many of the banks. The consumer behavior in Spain, it is very much different comparing to Northern Europe and Nordics. It's very important to understand the whole flow. It can't be only the risk that the lender is focusing on.
Välkommen till Kredit i Klartext. Mitt namn är Waldemar och jag driver podden tillsammans med gäster från branschen för att bättre förstå hur olika regler och kreditbeslut påverkar kreditgivare men slutligen också konsumenter. Jag har själv jobbat med kreditrisk på olika banker i Norden sedan 2013 och mitt mål är att ge dig som lyssnar ett perspektiv kring hur kreditmarknaden faktiskt fungerar och hur olika personer och deras roller påverkar oss som konsumenter i vardagen. Och dagens gäst är Jukka Suuronen, medgrundare och vd för ResultElf, ett bolag som hjälper banker och långivare att hitta dolda vinster genom optimering utav kreditbeslut. Och innan dess så jobbade Jukka över ett decennium på Salesforce, där han faktiskt grundade Salesforce Finland och ledde bolagets branschstrategi i Norden. Denna gång blir det mer internationellt perspektiv på samtalet, så vi kommer hålla det på engelska. Welcome, Jukka.
Yeah, hey, thank you. Thank you for the invite. This is fantastic to be here.
You've built Salesforce as an organization in Finland, and now you lead a company that helps banks to find hidden profits. How did you get from CRM into the credit space?
Yeah, that's a good question. Actually, the story goes a bit more in the 19th. So actually, I was one of the key founders also for Dun & Bradstreet early days in Finland. So that was my let's say first journey into the financing market overall. It was really fantastic time. We actually developed and launched the 3A rating to Finland at that time, and we also then developed the solution for one of the big banks in Finland. And at that time, it was already the semi-automated credit decisioning system. So with that, let's say my first sales job after that, we basically with one of the founders, Kenneth Hallin, we went to a different paths, and then I went to Salesforce, of course, being part of the country leadership team in Finland. We had a fantastic journey. We grew in Salesforce Nordics actually from 15 people to 600 people in the Nordics. And the company grew fantastically, of course, globally from $400 million to 22 billion as revenue and up to 60,000 employees globally. So that was a really, really fantastic journey in the life of the CRM. My last role actually was the head of industry in the Nordics in Salesforce. And then, as said, we met again with Kenneth Hallin, and we started to develop the idea that what could we do actually with an AI mathematical optimization to create something really special for the mobile lenders, consumer lending companies, for the industry, and then we pretty much founded the ResultElf.
So 25 years later, you kind of circled back to the credit space.
Absolutely, yeah, and that was an interesting turn. But when I got back to this industry and then met my co-founders, Juha Palomäki, for example, and Kenneth, they had worked actually in the credit industry 15 actually 30, 40 years. So we thought that we would have a actually fantastic group of founders for ResultElf.
Oh, wow. And you mentioned you've been head of industry for Salesforce as well. Which industry was it?
Actually, the Salesforce, we had a big market in the manufacturing. as you know, the Nordics is really, really strong in the manufacturing. So that was the industry, but I actually ran the Nokia as a global account in Salesforce, meaning that was a fantastic transformation journey that we were able to actually deploy globally for Nokia.
All right. So can you tell a bit about what problem in banking that made you want to start your current company, ResultElf?
Yeah, that's a great question. Kind of the one of the first ideas what I had in mind was that actually the financing overall globally it's not super fair if we kind of compare the different countries, different segments, and socio-demographics. So therefore, when we launched the company, we went day one actually global. So we had the first customers from Indonesia, Latin America. We had some projects also in Africa. So that gave us actually a great global view, and actually based on the fact that there is still approximately 3 billion people globally that are unbanked people. So they don't have a bank account, meaning that but they are, as you and me, they need also a financing support for their daily living. So therefore we thought that if we would create a technology company that could bring the lending companies and consumers together, meaning that right loan originators would actually find those families who actually need the money, but actually can also pay back the loan. So that would actually help a lot for those people living in the countries where the financing industry itself doesn't support them really well.
Maybe you can you tell about some of your work in the Nordics?
Yeah, of course. As said, we have been putting most of our efforts actually in the countries where the market requires technology. There is a certain demand for the mathematical optimization, AI-driven technology for the financing industry. Also, the kind of the size of the market has directed us into European markets so far, more than actually focusing to the Nordics. The reason being that the Nordics financing industry, it has been quite well technology driven, well established, and also the regulation has been quite let's say tough for digital banks in the Nordics. So therefore we have seen that our first and most lucrative market has been actually in the other parts of the Europe so far.
Okay. So are we talking about Baltics or Southern Europe or anything else?
Yeah. So we run our services. We have run our services in almost more than 10 countries. For example, the Baltic countries, Poland, Spain, Mexico, as an example. We have customers in Finland as well.
Okay, great. Why I'm asking this is just to give our listeners that are aware of their local situation, maybe in Sweden or in Nordics, some kind of perspective to the challenges that you are solving, essentially. So when you talk about those optimizations with AI that you provide credit companies and lenders, what kind of opportunities are they typically missing?
Yeah, thank you. That's a great question. So first of all, let's being very transparent. We are focusing mainly for the let's say mid-size digital banks and the mobile lending companies. That's our core segment, and they don't have all the resources, all the technologies, and that kind of creates an opportunity for companies like ResultElf. So it's and if we think about the whole customer journey, where the brokers, affiliates are marketing the loans, and then digital banks, lending companies are purchasing those loan applications as a leads to be able to select the right ones and issue the loan for the consumer. So that's how the industry in the consumer lending works. If we think about the whole journey, there isn't that let's say great focus of the customer life cycle and the lifetime value. So what we would like to do is that we are optimizing the value of that first from the first marketing step towards the customer coming as a return customer back and taking the new loan. So that optimizing actually the different steps from lead converting the lead, making the decision to issue the loan or not, like an approving or rejecting, and then making sure that there is a right limit, and we are able to actually make also the digital bank is able to make some profit of that loan. And if we think about the whole journey, the customer lifetime journey, it's quite difficult actually to manage the whole flow for one digital company, digital bank. And therefore we have created a technology to be able to deploy it in the different stages, because what we see actually when we have done some research, what we have found is that there is a lot of gaps, and that end of the day will not optimize the for example the performance of the loan for the digital bank.
All right. So if I'm just making a parallel to how it works in Sweden, it's we have a few of the credit brokers that have been trying for the past years to actually create this more sort of longer perspective to tie the relationship to the consumer that is coming for with their credit application. And even if they are unsuccessful today, of course the credit brokers want to keep the relationship with that consumer so that they can support this person later on when they are eligible for the credit, so to speak. And we've seen different ways to do that, from different mobile apps that they have been launching to kind of attempts to integrate their services within other services that feels more kind of natural to keep in touch with that consumer over a longer period of time. Because as you say, just being kind of transactional to kind of offering a new loan every year might have worked in early days, but kind of doesn't work now as we see the industry have been kind of more mature, and the the margins are also decreasing, so that becomes unprofitable to get that kind of switch all the time for all the banks involved as well. So just can you give kind of some perspective on how you are trying to solve this situation?
Yes, you actually touched a very, very important point. As said, the ecosystem is built on based on the brokers affiliates marketing the loans, and then lenders, digital banks actually to get their leads from those players. That relationship is not perfect. And therefore, what we have done, we have worked with the brokers and affiliates actually to optimize their match that the loan applications that they will gather from their marketing sites would actually find the right customer from the list of the digital banks and the banks overall. So optimizing the best match, because that is the difficulty, that we should actually find the best loan candidates actually to get the right type of loan. In the lender side, we put a lot of focus on optimizing the conversion, meaning that when the loan application comes into an digital bank process as a new loan application, we would actually be able to make sure that we convert the right ones, and therefore we kind of optimize the business for the broker and affiliate, but also create more value for the lender.
So let's say you find this ideal client, the bank that is mid-sized, that has the infrastructure in the cloud, so they can connect your optimization solution into their credit decision making process. So how does your optimization work in practice for the credit decisions?
Yeah, really good question. First of all, the mathematical optimization, which is in the core of our service, it's actually not that much used in many of the banks. So as a starting point, it creates the interest from their side, because their teams, they are not that aware of that technology and the methodology as a starting point. The second thing is that we would be looking for more openness in terms of using the partners and the partnerships, right? So meaning that all the wisdom, it's not always in your own office, and if we are more flexible in terms of creating the new digital partnerships, as we quite recently saw, for example, the Alisa Bank in Finland and the Nordea launching their partnership. That is a fantastic example that the industry is actually changing gradually, slowly, but these digital partnerships will be the key factor for the big banks to survive, because we have seen the change now where the Revoluts and these other big digital banks will take the markets like a hurricane, and therefore I'm kind of expecting and hoping that the small, medium-sized traditional banks, so to speak, would open their architecture for the kind of like a companies like ResultElf, where we can plug into their process, run certain service outside of their infrastructure, and then just feeding back the results for optimized credit limit, optimized profits, whatever they would be looking for.
All right, so that's very good that you actually mentioned credit cards as a specific product where you can really kind of shine and show the opportunity for the lenders. So if we take that as an example, because I love talking about like more specific examples so that audience also understands what we are talking about, even if they are not, for instance, working with credit cards. So for you guys who are familiar with credit cards as a product, this may be the basics, but for the others, maybe this revolving credit is not something new, but also there are some details that may need to be explained. So what is the common optimization objective normally when it comes to your client engagement? Is that like bottom line profit or kind of volume of the loans or anything else?
Yeah. Every digital bank lender, they have their own challenges. If I take the example, for example, from Spain, um, there is probably a 10 to 15 brokers in the market and affiliates that are serving actually the digital banks lending companies in Spain. There is a lot of fluctuation in terms of the volume and quality of their leads of the loan application. So they collect a lot of traffic, and then they are selling that traffic to digital banks, lending companies. But it's not. There is a cost associated to everything actually, every step in the process, in the broker affiliate side, but also in the lender side. So it's very important to understand the whole flow. It can't be only the risk that the lender is focusing on, because if you are not having the right pre-scoring algorithms, for example, to pre-score the lending application before it ends into your loan originator process and underwriting process, you might miss something big time, because every lead loan application you take from the brokers, there is a cost associated to those. If you don't spend money with the brokers, you will get less quality and less volume. So that is first thing where we need to actually think smart, and we need technologies to optimize that you will actually acquire enough volume to get enough good quality leads, loan applications, that will then convert to a good returning clients, consumer customers for you. So there's a lot of elements. There's like this pre-scoring, the step one. What would be the right limit? Could be an installment loan, short-term cash loan, credit card, and which of the customers actually bring us profits, which of the consumers will actually bring us loss. Understanding that, and then bring that performance data back to your process to optimize it iteratively again and again. That, if I would kind of summarize, that is something which is not actually easy to do, and that's the bread and butter where we think that we can add value. In some market, the 70 to 80% of the total volume of new loan applications for the digital banks and banks comes from brokers and affiliates, 70 to 80%. So that's the marriage. It might be sometimes hate and love or something like that, but that is the dynamic. So therefore, you need to have a smart strategy for integrating actually your broker affiliate traffic to your own process as a digital lending company. And therefore that's kind of one key thing. The marketing is happening in the many different let's say places. They need to have a budget for acquiring actually those leads, loan applications from the brokers and affiliates, because their own channels itself typically is not enough. So banks they do the marketing as well, of course, can be TV, radio, digital, but let's say especially for the consumer loan products, the lenders and affiliates are playing a really key role to get enough volume, and that is probably that has then been, of course, affecting into this broker affiliate market consolidation as well in the Nordics, meaning that some banks would have less vendors pretty much, and therefore the broker affiliate market has been consolidated in the Nordic countries.
Turning to your role, so if a bank is simply lending, when a bank starts to use your services, what kind of outcome is there for the end consumer? Do they have a easier time to apply, or do they have lower limit that they get, or what's the common result?
Starting from the consumer first, it might be naive thinking a bit, but I believe that if the world would be perfect, the right consumers would get right amount of financing, so that the lending companies wouldn't drive the families into trouble with over lending, right? So it would be an optimized relationship, that right families will get the right amount of loan that they can afford, right? And then the brokers should be able to find those applications from these right families and be able to allocate those to a right digital banks that has hopefully a good values and good let's say process to make sure that they will give the loan to the right families, optimizing the whole consumer, broker, lender, win-win-win. Okay. Then the second thing is then even between the broker and the lending company, they are I can't in the open podcast I can't always say as direct as I would like to say, but it's a bit of a like love and hate. So lender would like to pay minimum, and then broker would like to get best performance for shitty customers, shitty loan applications, big volume, lot of shit, to be honest. Now this is the opportunity. So we need to make sure that the shitty ones will be parked. No one shouldn't touch those, and there would be only the good ones flowing between the broker and lender, because it's in that case it's a win-win-win. Right consumers to a right broker marketing sites that will land to a right lending companies.
That's interesting. That's Jukka, that's really you got it there. Yeah, I'm happy you kind of finally touched upon this, your view really, to kind of debunk how it's how the relationship is and what's really the problem.
Yeah, and therefore the fairness in lending and affordability, those are one of the key drivers, which I believe that we are part of the industry doing the good thing.
So basically bringing the rates down, that's what you are talking about for the good customers.
Yes, indeed.
and that's something that I've been touching upon with other guests of mine before, that it's natural when you are not really sure what you are doing as a lender, and maybe you don't have the history in this specific product and this specific market. You need to start somewhere. You need to establish your baseline. So you just kind of set the rate, or like the interest rate arbitrarily, so that you can improve over time. And that means essentially that you are not very good on distinguishing between bad and good customers in the very beginning, which means that the good customers would actually pay for your losses unproportionately when your model is not very good. And that's just like the flaw of the product compared to when you can really kind of distinguish them, then you can make more specific pricing for the risks that you are actually taking for the specific individual.
I think there is a common challenge, and the common challenge is that even small organization, you have the marketing department, sales marketing, then you have your credit underwriting organization, then you have your collection department, then you have CFO, COO, and then you have your IT department. Kind of a overall structure. Even a smaller organization, it's a challenge that they would actually have their teams working across the whole customer journey hand in hand. So they are isolating every single thing, even in the smaller organization. And that can't be optimal. And what we are trying to explain, and the reason why we focus for mid-sized companies is that we always get, many times, not always, but if we get an access, we many times get access for the C-level. We have CEO, CFO, COO, CRO, Chief Risk Officer. The guys who are responsible horizontally across the whole business. And someone of those executives will understand that, yeah, actually, we need to, for example, to make sure that our conversion model is not unsynced with my credit model. Because this is what we have seen many times. Conversion people are doing just the conversion stuff, acquiring the leads and applications, and then they will send it to an underwriting, and this is not synced at all. And it's not well-oiled machine. It's not actually working optimized way for the digital bank at all.
And I completely understand why you are kind of working with those credit brokers, especially in those markets, or for those clients that require a lot of brokerage services, because I've been in touch with several brokers where basically like you would put like a product designer in charge of how the credit application works. And sometimes you kind of, especially on the broker side, you kind of stop worrying about the outcome in the end. I mean, of course you send your leads and that's it. And the end result is the actually when you start to think of, okay, what is the LTV of that customer when they actually pay it back in the end? That's the way you need to kind of optimize from very start of the marketing effort. What I'm hearing is really that the Nordics have been quite advanced in this kind of space in the market for consumer credit. and you're trying to take this learnings to other markets. But even if we take Spain, for example, as a quite hot market for Nordic banks that are trying to penetrate there, for instance, it still doesn't really work to simply apply the same manner that has been working here in Nordics. So what are you doing differently there?
Yeah, let's kind of bring this very important point, topic into the discussion. Even though we are the company from Finland, we see super important that we actually understand the certain market really well. And in this case, talking about Spain, we actually understand the Spanish market really well. The reason being that we run the services for the brokers and affiliates in Spain, and we run the services for the digital banks in Spain. Okay, so we understand the whole ecosystem really well. The consumer behavior in Spain, it is very much different comparing to Northern Europe and Nordics. So, and for many Nordic players entering to a Spanish market, the challenge is exactly what you said. They can't actually deploy the same approach, same models, same decision criteria, same even same process one by one actually to Spain, what they have been successfully deploying in the Nordic countries, because there is so much differences in terms of the ecosystem between the brokers and affiliates. First of all, there is a changes in the material or the quality of the loan applications. There is fluctuation and dynamics in the market that are different than we have in the Nordics, and that is super important to understand when you are entering to a Spanish market. But that is also represents an opportunity for us, because we believe that we can help the Nordic digital lenders actually to succeed in Spain. We have seen some companies that they have failed when they have entering to Spain. They have tried out the market a couple of years. They have stopped new lending. They have been just turning it as an collection organization. So, and we feel that that's kind of a bit disappointing, because what we as an industry leaders, we should cooperate. We should join our forces, take the smartest minds, make partnerships to ensure that most of the banks, digital banks going to a new market, they would actually succeed.
Kind of share the knowledge together to enter the new markets as a Nordic force.
Yeah.
Can you tell our listeners kind of the basic concepts behind the relationship between loan volume and credit losses and pricing that banks follow, well, to have profitable operations? We can take credit cards as an example.
Credit card, if we think about the complexity in the credit card, that's a massive complex business. The reason being that we can segment the consumers to let's say 10 score bands. So every application, every consumer kind of applying for credit card would land in any of these 10 score bands. Okay, there's a certain score bands where the all the consumers would take the maximum limit, but not consuming any of that. They just need the card as a second and third option. In that case, that customer is for you as a digital bank, that customer is just a cost because they don't use the limit. Other end, there is a consumers that they would like to take the maximum limit, consume it, but not paying back. Again, we will actually allow them to use the credit, take the risk, and then we will get actually the capital loss. Okay. Somewhere in between, there is a sweet spot of consumer segments. The consumers that would like to get medium level credit, they use it actively, so they actually consume it, the credit line, and they also pay back. So we need to actually have a balance, optimized balance of this whole portfolio, that how we would like to run it, because many times what we have learned in the real-time implementations, that the third payment cycle will show which customers are actually the good customers and which customers wouldn't be that good for the digital bank. So that brings us to this kind of the few key elements. It's actually the conversion, utilization of the limit, right limit, optimized limit, and then the risk and the payment behavior that the consumer will pay back. So that is the complex. That creates a complexity, especially in the bigger credit card volume. That what would be our optimized credit limit strategy? Should we decrease the limit for the certain segments? Should we provide increased limit for the certain segments to make sure that our portfolio would perform in an optimized way? And that in that case, we have been deploying the mathematical optimization, and I can tell you that's really complex stuff. Many of the companies that go to the market with the credit card, they don't have a such strategy in place. Is that the
how do they
example?
do that? Yeah, they're very good. And
yeah,
how would they do that instead? How they would just run the baseline and then try to adjust, or?
I think, of course, they are professionals in their industry. So what they do is that they kind of do their own estimation that what are the different limits that they actually apply for the cards, and then they kind of adjust it, perhaps not that frequently, but time to time. What I have heard from bigger banks, some people that have been working in the bigger banks for many years in the credit card division, they have been telling me that sometimes there isn't really a dynamic development on this segment. It can be quite old-fashioned, actually, in sometimes, and so therefore, I believe that in any industry you need fresh ideas, and you need certain, let's say, dynamic strategies to be able to deploy it based on the data and technology and algorithms, because then it allows you actually to optimize your strategy and your revenue and your profits.
Yeah, you mentioned that you basically have your framework that you put in place, and then after 4 or 5 months you already see the initial results of that initial strategy, and you can start working with that, sort of improving on that. All right.
Yes.
So what's the biggest strategic mistakes that banks make when it comes to credit optimization in this way?
Good question. I believe that different digital banks, they have their own challenges. Some might have, for example, that they don't have a healthy growth. But it's very dependent on the market and the bank itself where they operate. In the sum and overall their strategy, some of them might have more aggressive strategy for growth, but then they have to be careful in terms of really having the good grip of running the business, to be able to understand the customer life journey, lifetime value, being very let's say focused on the different steps of the life cycle, acquiring the loan application leads, converting, running the right risk appetite, monitoring actually the performance of the loan portfolio, and then bringing it back for iterative development. But I would see that the biggest risk for the traditional banks could be that they are too risk averse, meaning that they wouldn't be open for these digital partnerships. And then these more aggressively growing digital banks will come to that specific market and they will take it over, because they have developed the customer experience to a high level. They have the kind of how to acquire the customer, how to onboard the customer. They have been using this kind of these are the areas where they have developed the digital capabilities to a really high level. And if the traditional bank can't invest enough for developing a certain and similar capabilities to open their partnership network, meaning that, for example, creating digital partnerships for certain customer segments where the bank itself is not that willing to go, the example of Alisa Bank and Nordea. If they are willing to do that, then they can compete and be more agile. I see the big threat that some of the traditional banks would miss the boat when the new digital banks vendors will enter to these same markets where the traditional banks are operating at the moment.
Of course, and
so I turned your question like more like a threat.
More from the marketing, more from the business perspective, and this is
yes.
This is of course something that I'm hearing repeatedly from other guests on this podcast as well, that they always say never stop experimenting, never stop exploring, never relax, so to speak. That something that worked last year needs to be developed further this year, and you always need to think several years ahead, of course. And finally, if you could redesign a bank's credit strategy from scratch, where would you start?
You have a really challenging and tough questions, I have to be honest. I'm a big believer of evolving strategies and developing any industry to an next level and aiming for the future, where the future is going to be for the financial industry. Okay, and therefore I think that any organization, they can't be best in everything what they do, so they need to pick their fights. They should focus in the certain strength areas where they have a good customer base, loyal customer base, certain financial products that are performing really well, to make sure that they will be able to benefit of these loyal customers. Second area would be that they should have these digital partnerships to expand and integrate actually their strategy with other players that would bring perhaps new customer segments into the ecosystem of that traditional bank, meaning that there would be a cooperation, different roles. Other organizations could do the marketing. The traditional bank could finance, bring the financing backbone, for example. So because you can't be all over the place and be the best marketing company. You can't have the large portfolio where you could ensure that you are competitive in every one of those. And then,
So basically, you're talking about that a bank should really kind of select what they're best at, and not try to become a marketing agency or compete directly, but rather getting the services from the experts and becoming an expert in their own niche, so to speak.
Yeah, but also this partnership will allow you to get access to a certain customer segments where you naturally you don't have that capability or skill, and partnership would bring that to you, and you could make more business out of those partnerships. And then the third thing is actually this technology. So modular architecture, cloud-based core banking, modular architecture where you can plug in new value-adding technologies like ResultElf, for example, which can bring you the certain very niche expertise like credit card strategy optimization, so that your architecture wouldn't be the old type of legacy where it's very hard to integrate the new value-adding players. It should be flexible. There should be let's say flexible APIs, so that you would have more opportunities actually to plug in other services and then be able to kind of be enabler for expanding your footprint rather than just maintaining your own box and being inside of the box.
Yeah, so instead of competing on all fronts, you become part of the ecosystem and really try to excel in one of the main tasks, so to speak. Jukka, thank you very much for your insights on how the banks can be more efficient and profitable with the right adjustments to their entire credit flow and credit decisions. Och till alla lyssnare, glöm inte att följa Kredit i Klartext för fler samtal om hur kreditbranschen förändras bakom kulisserna. Vi ses nästa vecka. Ha det gott!